Welcome to part two of position sizing. So what we went over in the previous video is the different sizes of position or different sizes of positions, right? Micro lots, mini lots, and standard lots. All right. And we talked about what each of the how much money or how much money each of those position sizes would make or lose us when we're trading. Correct? So uh, if you wanted to enter, let's say you spotted a trade and you wanted to enter one standard lot and earn $10 per pip on that trade, right? And let's say you wanted to catch 200 pips and potentially earn $2,000, right? Uh, Basically, it's going to cost you a certain amount of money on hold, which is called margin, in order to enter a trade. And the amount of margin required for a trade depends on one, your position size, of course, and two, something called leverage. Leverage is something that your broker provides you in order to trade with. It's almost like a loan, right? And so if we break down how much each of these position sizes represents, it'll start to make more sense. All right. If you wanted to enter a one standard lot trade, one standard lot represents 100,000 units of currency. So if you're trading, let's say, the euro versus the dollar, right, and your quote currency is the US dollar, right, the second one, then the units you're trading will be in dollars. Meaning that in order to enter a one standard lot trade, you would need $100,000 in your account to enter that trade. Now I know you're thinking, wow, like I don't have that kind of money, or whatever the situation is. This is where leverage comes into play, and this is why the forex market is so advantageous versus trading stocks or options and futures and things like that. Is forex brokers give you something called leverage, to where you don't need $100,000 to enter that trade, because they're providing you with something called leverage. Now these are down here, these are common leverage amounts based on brokers. Many brokers allow you to select your leverage, and some brokers go anywhere between 1 to 100 all the way to 1 to 1,000. Okay, and so what this means is, for every, let's say you have 1 to 100 leverage on your current broker. What this means is, for every dollar in your account, you have $100 of trading power, right? For a 1 to 1,000 leverage, you have, for every dollar in your account, you have $1,000 of trading power, right? So if you wanted to enter a one standard lot trade, and it costs, and basically, one standard lot represents $100,000, right? How much how much money would you need in your account on hold, margin? How much margin would be required in order to enter $100,000 trade, one standard lot? You would need $100. How do I know that? Because $100,000 divided by 1,000 is 100. Okay, so you would need $100 placed on hold in your account, which is called margin, in order to enter a one standard lot trade. And then, of course, you would need additional funds in your account to handle the trade itself, because you're making or losing $10 per pip. Okay, so let's go down here. So as I've written already, okay, margin equals money on hold in your account based on position size. Okay, of margin required for a trade depends on leverage and position size. Okay, so here's an example I've written down for you guys. Let's imagine you have 1 to 100 leverage on your broker. You spot a potential trade setup and want to trade one mini lot, written like this on most brokers, 0.10 or zero point 0.1. You want to trade one mini lot on this trade, right? So one mini lot, as we know, is basically you're making or losing $1 per pip. Okay, one mini lot represents 10,000 units of currency, right? So If you're trading euro versus dollar, one mini lot would represent $10,000. At 1 to 100 leverage, you would need $100 for margin. Okay? Now let's look at the same trade but with higher leverage, 1 to 1,000 leverage, right? This is more trading power. Let's say you spot another potential setup and want to trade one mini lot again. One mini lot is 10,000 units of currency. At 1 to 1,000 leverage, you would need only $10 available in your account to put on hold as margin, right? And if you do the math, there you go. 10,000 divided by 1,000 equals 10, right? Or the other way to figure it out is you have $10 for margin. You only need $10 of margin because if those $10 in your account multiplied by 1,000 would be $10,000. So that would allow you the trading power to open a one mini lot trade. Now, the higher your leverage, the less money you need to put on hold, aka margin, to open a position. Remember, it is important to have enough money to cover your margin and the size of your risk, right? So you don't want to just only have enough money in your account to cover your margin. You also want to have enough money in your account to cover the amount of risk that you're taking on a particular trade. Also remember, the higher your leverage, the easier it is to, let's say, run out of money or blow your account. Why? Because you're trading with more power, right? So the higher your leverage, the higher your trading power, the more money potential you have to make, but also the more potential you have to lose money. Now let's look at this example I've also written out here. You have an account of $1,000, and make sure you guys are really understanding this, really writing it down, because it's very, very important that you get this. It's a lot of math, but once you get it, you'll get it. All right. Let's imagine you have an account of $1,000. You spot a trade that you're determined needs a stop loss of 50 pips. You're willing to risk $100 on this trade. That means your position size needs to be 2 mini lots so that the value of each pip gained or lost is $2, correct? You have a stop loss of 50 pips. Each pip is worth $2. If, let's say, you lose, the trade is going against you, right, and you're willing to lose up to $100, that would mean that your position size needs to be 2 mini lots, $2 per pip. 2 mini lots represents 20,000 units of currency, or $20,000. That means, based on your broker, let's say your broker allows you 1 to 1,000 leverage. That would mean if you wanted to place this 2 mini lot trade with this amount of leverage, you would need $20 of margin. 20 times 1,000 leverage equals $20,000. So you would need $20 of margin. But also remember, you would need at least $100 additional in your account to cover your risk. Now, once you close that trade, whether you win or lose, you get the $20 back. As I mentioned before, the margin is just a hold in your account, right? It's just a hold. Once you close that trade, that money is back available in your account. But for this particular trade, the minimum that you would need in your account is $120. Now, that wouldn't be smart to, if you had a $120 account, it wouldn't be smart to place a 2 mini lot trade, use 20 for margin, and the rest of your account, the $100, for one trade, risking that whole account, right? Now, in this example, we had a $1,000 account. So you're risking $100, $20 is margin on hold. After you close the trade, let's imagine you won the trade, your account balance would now be $1,100 if you won that trade, right? Because it would not be 11 unless it was a 1-to-1 trade. So if you were risking $100 to make $100, then yeah, if you won the trade, your account balance would be $1,100 at the end of that trade. If you lost the trade, your account balance would be $900 at the end of that trade. That $20 of margin does not come out of your account permanently. It's only a hold.